Perfect, guys. Another one coming in. Tudor, thanks for being here. So thanks overall, guys, for being with us. I think now we have the panel complete. So thank you, Agora Group, for the warm welcome, and thank you guys for joining us. I know it's lunchtime. I'm glad that you made it. I'm delighted to be here, and I'm Alexander Jais, the founding partner of Yap Capital, and we are discussing a very relevant topic today. What are the key trends and challenges in 2022 and beyond? Luckily, we have a very smart panel here today. Thank you guys for joining us. We have Azam from Eterna Capital, Christian from SEPA Bank, Omar from Matcha Capital, and Tudor from Headstarter. Quickly, can you introduce yourself, your company, tell the folks out there?
Okay, hi guys, I'm Asim. So Eterna Capital was set up by 4 founders. 3 of us are ex-BlackRock Asset Management in London. The 4th is a serial entrepreneur and a global NFT artist. We launched our first fund in 2018. We're now deploying our second fund. And yeah, we generally invest globally with a focus more on US. And you know, seed, Series A is where we usually invest.
Thank you.
Hi, my name is Christian. I'm the Senior Executive Officer of SEPA Bank. We are one of 2 licensed banks in Abu Dhabi offering crypto. And we are operating since the 22nd of February of this year. And we are 3 years in the market out of Switzerland.
Hi, yeah, it's Omar Rahim from Matcha Capital. So we're early stage investors in crypto. We operate out of Europe and the MENA region. And specifically, we target very early sort of pre-seed and seed stage companies in the Web3 space.
And I'm Tudor. I'm the founder and CEO of Headstarter. Headstarter is a launchpad and accelerator for the Hedera ecosystem. And what our main focus is right now is to drive attention from anybody from developers, investors, and entrepreneurs to come and build on Hedera. It is a unique and very versatile layer 1. And our main focus right now is to grow the ecosystem.
Thank you, guys. So before we're going to talk about the trends in 2022 and beyond, I just want to recap the year 2020, which has been obviously not a very pleasant one for the crypto market. I mean, we have seen the Luna crash, we have seen the Celsius meltdown, we have seen the fall of Three Arrows Capital, and now the most prominent one, which is the FTX collapse, and we're going to talk about that right away. So Azam, when you heard about the FTX collapse, what was going through your mind?
I think the first thing we had to look at was which of our companies are exposed. Now, none of our companies had exposure to FTX directly, but there were some companies where FTX or Alameda Research were investors in them. So that was, you could say, an exposure which really didn't impact them because they were not token deals where we were under some kind of threat of the token being dumped on the secondary market. It was just purely equity deals where we generally focus. And then after that, to be honest, I wasn't too surprised with given what's happened this year. And I think we have to be accustomed to black swan events happening more often than black swan events should happen in crypto. And you know, if you look at what happened with Celsius, you know, what's going on right now with BlockFi and, you know, Luna, if there's anything to learn, it's that leverage plus volatility don't mix. And that plus a few other, you know, major, whether mismanagement or fraudulent issues that occurred, these types of things seem to be a bit too typical in our space. And I would also say one thing which I always keep in mind is, you know, it doesn't matter who you're speaking to, you know, if you look what happened with FTX especially, because of the profile of the person leading the firm, it doesn't matter who is trying to be the face of crypto, you cannot really know what's going on underneath. And it's never the case that the bigger you are, you know, you're too big to fail. If anything, the bigger you are, the harder you will fall.
True. And do you expect that there are more fail-outs coming in the next couple of weeks, or do you think we have seen the maturity right now?
I think there's pressure on some other large firms, and I think we are seeing that pressure mount up to, you know, potential solvencies. And I think, you know, a completely separate thing to the FTX is also a lot of pressure on mining companies right now as well.
True.
So I think there's a lot of contagion going on with which is all effectively all linked to the downward movement in the markets. But this should also represent a blue sky opportunity for startups who want to build and build better.
Does make sense. Thank you. Tudor, do you have anything to add? What was on your mind?
Yeah, I really want to echo on top of what Asim just said. You know, whenever I was speaking to my friends or my peers, and I was talking about crypto this year, I was always telling them that, listen, it is at the point where it's pretty big too big to fail, right? You have crypto lobbyists, you have MBA arenas that are being called after exchanges. So I'm sure that everybody who wasn't really in on it really was kind of like blindsided about what happened. Luckily, I mean, the exposure that we had was none. But what I'm thinking at this point, and I hate to sound like a purist, is that this is a unique opportunity to really look at ourselves as an industry and to really appreciate where we started from and some of the grassroots movements that the cypherpunks, the real decentralization that these people wanted to promote. It's a good chance for us to start looking at these values a lot more, because we've been blessed by having a lot of experts coming to the space from banking, and I feel like, at least for a little bit, we kind of lost our way. Today, right, we have 3 and 4 in market capitalization, USD stablecoins. I think like there's a real chance for us to come up with a better disruption in the crypto.
Thank you, Tudor. Omar, I'm more precisely interested in your opinion about the involvement of Binance, since you have been a former employment in Binance, and especially how CZ impacted the whole FTX topic.
Yeah, no, absolutely. I mean, first of all, I don't like speaking about FTX without using 2 words. The first one is scam, and the second one is fraud. And I think we should be really clear about that. You know, this wasn't some mythical company that suddenly surprised everyone and you know, made some mistakes. This was fraud on a wholesale level, and it was caused by pure greed. Not just with FTX, but with the investors, with the people that gave them an easy ride. And you know, we all need to think about it, and you raise a very good point about reassessing where we are as an industry. Yes, to some degree, there's nothing, you might argue there's nothing you can do. If one person or one huge company like FTX is corrupt, what can you do? I don't buy it. I think the whole industry in some way is responsible. From, you know, all FTX were, when you spoke to FTX or Alameda, intentionally, the same thing that Wall Street does, the same thing that Silicon Valley does, people tried to make it more complicated than it is, to make you feel stupid. And everybody in this room has the ability to understand the question. I have a test that if I can't explain a concept to my 70-year-old mother in simple terms, I don't invest in the company. So this whole industry, or this whole run-up in this bull market, was designed to make people feel stupid. When you were speaking to people, I'm not a programmer, I'm not from a technical background, I come from a financial background. When I'm sat there talking to people and they can't explain to me where a yield comes from, where their money's being parked, how they're generating their returns, have they stress tested their strategies, if they can't explain that to me, then something is wrong. So the warning signs were there. I'm not going to pretend that I have a crystal ball and I saw FTX coming. Of course, so many people got caught out, even very experienced people. But what I'm talking about is it should be a wake-up call for the journalists that wrote these puff piece articles on FTX, for regulators that gave them an easy ride, for investors that knew exactly what was going on and continued to invest in FTX. So, you know, to your point about taking stock, yes, absolutely, the market should look at, okay, what have we done as an industry to allow people like that to be put on a pedestal? So that's the first thing to say. And very briefly, you asked about Binance's involvement, and you know, I used to run Binance in this region. And you know, I think CZ has been quite vocal on this, and a few people have asked. I had a conversation with a colleague today about whether CZ did the right thing by exposing this. I wasn't party to the private discussions between Sam and CZ. At one time, you know, clearly they were friends of some sort, co-investors. in FTX. At some point that went sour. Now, whether you believe that Binance did this as an aggressive move to take down a competitor, or whether you believe they exposed a bad actor, it really depends on interpretation. For me, those bad actors deserve to be exposed. Whether CZ and Binance acted in the right way and did it in the right way is something that will divide opinion, and I don't think we'll kind of get there today. But one thing is for sure, I think each and every one of us should look at the people that we're keeping in our circle
100%.
and the people that we invest with, and that's something all of us can do.
Thank you, Omar. Absolutely. This basically also leads to our next question. Christian, how do you think this whole setup was possible? I mean, there were so many VCs, as you mentioned, Omar, involved. There were so many supposedly due diligences be made. Why do you think that there was nobody pointing out what they're doing? Do you think that they first of all knew, or they just didn't knew and participated because of some formal reason?
Well, for me, the Bahamian regulators did the mistake in regards of looking at the papers. For me, FTX was too big for them to handle. It was too complex. We got a lot of calls from FINMA, the Swiss regulators. They asked us about our exposure, if we had any exposure. They wanted to understand if the funds are safe or not. And also here in Abu Dhabi, we had lots of calls, and we had to clarify what we do different. And I just see and think the whole thing was too big.
Got it. Thank you. And what do you think will lead this all to this? I mean, what do you think the implications will be, Tudor? What's your opinion? What's happening now?
There's an array of probabilities, right? I mean, when we look at the future, and we're talking specifically about the blockchain technology, we can see a future that is potentially dystopic or a future that is utopic. And I think that, conspiracies aside, this set a dangerous precedent, but the regulators really need to, when they're going to clamp down, and we're going to see a lot of regulations next year, but when this all comes into play, we need to make sure that the technology is understood correctly, and also our sovereign liberties are respected. So I really hope that everybody will pull for the industry to make sure that privacy, zero-knowledge proofs of identity are all respected when it comes to the future applications and to the new regulations that will be playing out.
Thank you. Do you have anything to add, Asim, to the implications?
Yeah, I'd say that it's definitely hurt the industry reputationally, and also in terms of a lot of the, there's a lot of collateral damage perhaps on companies which haven't, done anything wrong. But at the same time, we need to flush the system of anyone else who's mismanaged and therefore, fallen into this contagion at the same time. But it's all
I think something that's very interesting that should be coming up pretty soon is to make sure that we have the right tools to use DAOs in a more dynamical way. Everything is pretty static at the moment, so if you have a lot of more infrastructure being built around DAOs, open treasury management, to Asim's point, these type of transparency exercises, while again preserving anonymity, I think is something that is very important and should be one of the leading factors in the new crypto bull market, hopefully. At the same time, we also have had a lot of metaverse, GameFi stuff, and a lot of Ponzinomics, as the word is has been coined. So I think that hopefully we're going to learn a lot from our past experiences and come up with applications that really provide real yield. At the same time, real-world use cases on Hedera, since it's a network that is pretty enterprise-focused. We see a very high level compared to other chains of enterprise applications or B2B type services. I call these section of the crypto startups Web 2.5, and it's really breaching the gap between retail and business and making crypto a lot more semantically understandable.
Thank you, Tudor. Fantastic. So, Omar, would you agree with him that everything is going to be like a subset of trends, or do you think that it's going to be like a huge?
Yeah, no, I think that's sort of covered 50% of kind of our view of the future. I think in one basket you have, from this whole crisis, you have the move towards decentralized exchanges, security, and obviously DeFi applications, let's say DeFi 2.0 with user cases. I think I'd put that in one basket, and I think we will see a big trend next year in projects like that. The second this is a cool new app, you should download it. So I think you will see a big trend in 2023 for Web2 onboarding via things that you might not expect. In terms of, we had gaming, we've had media, we haven't really had social media volume yet.
Okay, sorry, so one of our panelists says we have a meeting right now. Thanks for joining us. Perfect. So, Azim, do you want to add anything to the comments from Omar and Tudor about the DeFi space?
A few trends which I'm seeing and what I'd like to see is we're seeing a lot of analytics platforms coming on which are basically allowing people to understand DeFi data better and make better informed decisions. I think multi-party computation, self-custody solutions which move people away from private keys is going to be important and is something that's going to take off. If we have another DeFi cycle without insurance, I don't think we're heading in the right direction. I'd say those three trends, which I think are like mini trends within DeFi.
Perfect. Thank you. Let us now talk a little bit about the gaming sector, since games has been a very important part of the crypto community this year and also last year. And there is also, in my opinion, a big relevance within the DeFi space. And most of the projects we've seen are basically a gamification of the DeFi space in some way. So, Omar, what is your opinion on that? Do you think that this play-to-earn concept, which we have seen over the last month, will continue, or do you think there needs to be adaptation improvement?
Yeah, I think there will be a slight tweak in the model. We went from crypto people building games, and I think we will switch from game people building blockchain-based games. And I think that will be the big trend in gaming, because and it's fine, by the way. I'm not knocking crypto companies equivalent of large corporates and institutional players coming into from a financial market background, I think you'll see the equivalent from big, well-known gaming studios making games much more accessible. So from that perspective, someone will hit big, and the usual suspect, whether it's someone like Epic Games, for example, there will be a big moment when people realize, okay, we don't have to understand blockchain, we don't need to use the word NFTs in every other sentence in our marketing material. We just have to make the game good, right? Make the game enjoyable and have those tradable assets. And some big studio will come along and do that, and I think they will sort of dictate the pace of where the industry heads. So for me, the gaming, the play to earn model will be turned on its head from gaming studios leading a lot of the charge.
So basically looking at the games per se, making the game 2.5 crypto alike. So it's not, okay, we're looking from the crypto sector and build a game, so we're looking from the gaming sector and try to make it more comfortable with the crypto space, which is coming from the other side basically.
Yeah, I think so, because what a lot of the companies did that develop games is they forgot to make the game good, right? They didn't. I've looked at so many games, and I can sit there and someone can sit in front of me for an hour explaining the token economics and the internal economy, but if the game's no fun to play, it's never going to catch on. So I think projects will start to realize that from that sector to make games more playable.
Perfect. Tudor, do you have any comments to that, to the play to earn topic?
Sure. So when we look at the play to earn movement that Axie Infinity had, it was really propelled by that had managed to buy those NFTs, and then so to the previous point, obviously the games and the pool of the latest GameFi in crypto are AAA games. Layer 1 managed when it comes to the actual GameFi that's being built today, a lot of the discussion continues to lie in the constant inflation of the NFTs, of the game assets, of the tokens. So I believe that when the real game studios like Ubisoft, who's a company that's building on top of Hedera, a lot of their gaming applications, these entities will be able to manage their assets a lot better in game because they have the experience from the previous Web2 space, and then therefore the whole ecosystem becomes a lot more sustainable. Now, when it also comes into GameFi, I think another important point that gamers always had against the space is the carbon efficiency and the pollution that we're pushing onto the environment. And I believe that with the upcoming scaling solutions, with building on layer 1s such as Hedera or other more efficient ones, I think that hopefully this thing will become a subject of the past.
Thank you, Tudor. So we have now touched the DeFi space and the gaming space. Let us now talk about the infrastructural topics, which I personally think are a very important one going forward as well. Azim, what do you think are the topics we're going to see or trends in the next coming month or years ahead for the infrastructural topic?
I think there's going to be a lot of things because, the way we conceptualize where we see Web3 going in 5 years is open finance, where it's everything from DeFi to real-world assets coming onto the blockchain, digital ownership, whether we're talking data or just people having self-custody, and then the last one is NFTs and metaverse, which is, you could say, the creative economy. Now, to have all of these, the enabler for all of this is infrastructure.
100%.
And that is really important because right now some key components are missing. Like, just to give you an example of one of our invested companies, which actually Alameda Research was actually invested in as well, it's called Snickerdoodle. They're basically building cookies for Web3. And this is quite important because, people like Uniswap, Aave, they want to understand the profile of their users, what else they interact with, how they behave. And that's what cookies does on Web2. And, this type of information is important for companies even in Web3. And we need some of that Web2 functionality in Web3 while we're building new things, we are losing some beneficial old things. And this is, core infrastructure, I believe.
Understood. Thank you, Asim. So basically what you're referring right now is building products or projects which are improving the ecosystem within. And Omar, do you agree with us that the next wave will still focus on the ecosystem within, or do you think that which you basically already gave us a glimpse to it, that some project will try to help to get more Web2 users onto the space? So we have like a shift from improving the ecosystem to, okay, let's try to get more Web2 users through onboarding, interfaces, etc. What do you think here?
Yes, I mean, generally I'm very bearish, a lot of the L1s. I think that it's an unsustainable model. See, this is how generally the L1s worked in this market. We raise a ton of money on a deck with some smart people, and then we use that money to pay people to build on our infrastructure. How long can that last? I think the opposite. I think you're going to get a consolidation around the Ethereum ecosystem, just like we saw in the early days of Google. You'll get consolidation gradually, and Google will emerge as a dominant player. Yes, I believe in decentralization, but no, I don't believe having Ethereum as a dominant system is a bad thing. So I do believe you'll see consolidation around the Ethereum ecosystem, and I believe, to build on the previous point, that you will see really smart applications in niche areas of infrastructure that will improve the Ethereum system. This idea that it won't stop anyone raising for another L1. We will see more. I call them VC coins. You'll see more VC coins because people can do it, right? People can raise for an L1 because if I'm an investor and I think, wow, I can invest 5 million in this project and then I can dump my positions for 500 million on the retail market, of course, most funds are going to say, yes, I'm going to do that. So you will get one or two of those projects, but I'm very bearish most L1s in the current ecosystem.
Got it. Thank you so far. Since we do not have too much time left, I also want to talk about the flip side of the coin here and quickly touch the challenges going forward. So, Asim, what do you think are the main challenges we are facing now, based on what we have went through in this phase?
I'd say regulation is likely to tighten, and that could be a good thing because in some ways, but also bad in other ways. So one thing, which you have to highlight in this situation is whenever something bad happens, it's always retail who gets screwed the most, right? So I can see why some regulation is needed. But if it tightens, then we don't want it to stifle innovation, and I think that's going to be key. Now, on top of that, I would add that there's no shortage of capital. So when we talk about any issues in the future, there's enough VC capital to go around, and we just need more people from Web 2 to come to Web 3, and more people from TradeFi to go to DeFi, in my opinion, because there's certain things which people who have expertise in certain industries need to bring across. Because for me, the perfect blend is having the expertise of TradeFi with the philosophical thinking of decentralized and Web3 infrastructure, and seeing that as the future. And if you combine those two, you can do it the right way. Because developers by themselves, yeah, I've seen some very interesting things. Let's just say that.
I absolutely agree with you. It's quite surprising to me that most of the people are not talking about bringing more senior guys into the space, to be very honest. Like, there's a lot of discussions about the regulations and what they could do and how they could harm it, but they could also try to get more senior people onto the space from the old world who are more experienced. And I personally would argue the FTX collapse wouldn't have been that way if there would be more senior guys around doing the operational work. But Tudor, do you have anything to add to that, to the whole challenges topic? Like, do you think that the regulations will help, or do you think they could harm?
Regulations and a certain guideline will definitely help going further. There's so much confusion around how to have a startup in the space, how to that is sustainable and can succeed over the years, has been a very high level to entrance. So I think that clarity around this will definitely be beneficial.
Thank you. So I want to have one last question for each of you. Who is out there for you as a North Star, doing great work, trying to solve one or more of the challenges? Do you have anybody in mind? Azam, you go first, and then.
Sorry, what was the question?
Who's your North Star? Do you have one project in mind which is already tackling one of those issues you already laid out right now? Do you have a project in mind for you? Who's doing great work, or?
I think yeah, there's one distributed finance, which is DAO tooling. Now, I think one issue we do have is there seems to be more DAO tooling than DAOs right now. But at the same time, you know, there's lots of people who want to, you know, gather as a community with a fixed objective. And whether you're all in one room like this or you're spread across the world, it's a way that people can come together and produce something. And when done right, I think that's something that can be, you know, very powerful as a movement. And decentralized finance, distributed finance, this company I'm invested in, they're doing it in a multi-chain way with legal entities backing them so that it's fully, you know, you can even interact with the real world because you can have a bank account and actually make real world differences, whether you're opening a charity or some kind of foundation or running a business.
Thank you. Omar?
Yeah, I mean, I think a very, very obvious answer for me really would be, for me, is Vitalik and his continued belief in decentralization. For me, I think he's a good actor in the space. He's not beyond criticism, and there's plenty of people that will criticize him, but I believe he is fundamentally a very big net positive for the space.
Perfect. Tudor, take us home.
Well, for me, I'm going to give a shout out to everybody who's an educator, a lobbyist, and fighting the right war for crypto. There's a lot of unsung heroes that are not as prominent, and they definitely deserve a shout out.
Thank you. So thank you, the panel. Thanks for discussing with me. Thank you for listening to us. Thank you, Agora Group, for hosting us. Great event so far. And thank you.
Very well done. And I'm glad you mentioned Vitalik. I was wondering if someone was going to. That seemed like the on point. We take a photo of the group? We're taking a photo of the group? Let's do that. All right, again, a big round of applause. I like that we came off lunch with a high energy panel. That was very interesting. Well done. All right, next up, we have our the next panel discussion, which is gaming and investments, how NFTs are transforming games. And I would like to welcome on stage Sami Karim as our moderator. He's a general partner of Zoco Move. Sami, are you here? Is that a yes? Yes, yes. Sami? Big round of applause, please, for Sami. And also, let's see here, Faris Al-Sadek, Managing Partner, Gulf Capital Partners. Paula Tavangar, Principal of Swissborg Ventures. Paula, welcome. And you can keep on applauding, it's okay. Keep the energy. Jamie Thompson, CEO of Vulcan Forged. And Pratik Gauri, Founder and CEO of FireWire. Come on stage. Oh, okay. James Anderson, pleasure. Okay, go for it.
Good afternoon, everyone. Welcome, guys. So welcome to this panel. We're going to be talking about investments in gaming. I know the panel guys before here had a little conversation about some of these topics as well. Maybe we get started, just quick round of introductions. We can start with you and go down. Tell us a little bit about yourself and what you're focusing on.
Sure, thank you. I'm Paula Tavangar, and I'm the principal of Swissborg Ventures. We're the investment arm of Swissborg, and we do strategically aligned investments. For me personally, I'm coming back from traditional finance. I have been mainly focusing on structuring and trading. I'm also the co-founder of Genesis Capital, which is a private equity firm, and also focuses on arbitrage and quant strategies.
My name is Reggie. I'm the founder and CEO of Gather Network and a partner at GAF Capital and one of the organizers at Crypto Fight Night. I'm a leverage trader and DGen who likes to also go into shitcoins.
I'm James Anderson. I'm with Plutus Venture Capital as a venture partner, and we're a venture fund out of Hong Kong. We have about 200 million assets under management, and we invest in all different kinds of crypto token projects, infrastructure, GameFi, Metaverse, DeFi, hybrid models. We invest in both tokens and equity, mostly tokens though.
Very cool. So so this panel is about gaming. There's a lot of different topics to talk about. Maybe we can get started about why do you think that there's like very high interest in gaming as a way to drive crypto adoption? I think like a lot of people talk about that, but at the same time, like if you look at, I think the panel before mentioned Ubisoft, and Ubisoft tried to do this NFT marketplace. There was like massive backlash from like gamers themselves. So there's like a big disconnect here. Like when you talk to people in crypto, super bullish on gaming, but you talk to gamers, they don't really see it in the same way. So keen to hear your perspectives around that. Like where is this gaming investment hype coming from Web3, and what are like the challenges on the other side from like the gaming community? We can start with you, Paula.
Yeah, I've been hearing the same thing. Last week we were on a panel and we were discussing basically when eventually the bear market will end or will start to reverse. And there were some comments from very knowledgeable people that gaming might be one of the key triggers for that. I'm not so sure if I agree on that, but I believe that all the hype about gaming is coming from the fact that they have already an existing community and a use case for it. So the example of Ubisoft, so if they implement the marketplace, eventually the gamers will just get used to it. Like we don't really like new things. We always like the old until we're not pushed to use the new things. So I think that's a big opportunity. And maybe when we talk about NFTs, maybe I'm the worst person possible to be on that panel because I'm not a fan of NFTs myself, like the way they are at the moment. I really believe that there should be high level of utility, or there are many applications, but definitely not the way it's sold today. So maybe gaming is the only one where they have some actual utility, and it makes sense. For me, just the one major issue I'm seeing with that is that there is no interoperability between the games. So let's say if you invest and you buy the best possible avatar, you spend like 20 hours per day gaming and you get the best things, then these are just for this game, or maximum if it's a gaming studio, eventually you can use part of those into another game. But there are a lot of limitations. So that's why I'm a bit neutral. I'm not one of the believers that will be the big wave that will drive the market upwards. But there are a lot of believers, and even the fact that in a bear market, there are a lot of new funds set up solely for the purpose of investing in gaming, I think it's a huge sign.
I think why you're seeing a lot of investment in the gaming is because one is just the pure user base, the amount of gamers that are out there, and then the demographic. Right? I mean, 5 years ago, all of us people, or most people who were there, you're sitting on Bitcoin Talk on your computer for like, I don't know how many hours in a day, trading on the old ass exchanges like Mt. Gox and all that. Rip to Mt. Gox and whoever still has Bitcoin there. And then the disconnect comes is that because people are trying to push things like NFTs, tokens into these walled gardens, that just creates extra barriers for gamers, right? Like if you go play a game, let's say League of Legends, one of the most popular games out there, you already have in-shop currencies and things like that. And then there's the other aspect where there's a large disconnect is actually from the owners of these games. So a good example is Rockstar, right? GTA Online, they have what's called role-play servers. They just banned any type of in-game virtual currencies and NFTs as well. The use case is valid in there because the demographics match, and the user base is there, but again, it's about peeling back those walled gardens like Rockstar or even Apple, as an example, have put in place right now.
Yeah, I definitely echo the sentiment of the size of the market. I mean, depending on how you define gamers, about half the world's population is considered a gamer at this point. When you consider mobile games, I mean, my parents, my mom plays Candy Crush, my dad has like free slot play games on his phone, so anyone of any age can play video games. there's the hardcore gamers, which some of them have been quite vocal against NFTs and things, but a lot of the more casual gamers are interested in the space and they're excited to learn more. A lot of people like the idea of being able to own the in-game assets, actually have value on that. I've spent so much money on League of Legends skins, but I never play it anymore. So none of that money is mine. Again, it'd be great if I could, resell those, get some new items, invest in different things, So I think this kind of transposability about having game characters that can be resold, but also transmitted between games, especially when we start talking about things like the metaverse and the world going digital and VR and all these things. It's like if you can actually move those IPs, famous IPs, whether it be Disney, Marvel, and put those into the various universes, and then you also have these new IPs. This GameFi model is also flipping the industry on its head in terms of the speed of fundraising. You can prove product market fit to some degree right away because people like the concept of your game. So I think, you have the demographic piece of it, which is that a lot of millennials, Gen Z, et cetera, are avid gamers, and they're also into crypto. They're open to new things. And gamers are dopamine junkies, let's be honest. So they're excited to, whether it be play the games, learn new things, they're innovative, and sometimes they like to gamble both within and outside the game. So, yeah.
Yeah, that's pretty interesting because I think a lot of people assume that for gamers they will just naturally comfortable with digital assets, right? They're just grew up just comfortable with digital asset ownership inside games, but within closed economies. So Web3 games, crypto games, supposed to change those business models a bit, but what we got ultimately was play-to-earn games. The end result is yet to be seen, but from what we can see now, worked well in the bull market. Axie Infinity was great success story, case study at the time, but when things went the other direction, it's not as sustainable. User growth has significantly dropped, and we saw that maybe there's opportunity for different types of business model within crypto Web3 games. So interested to hear from the investor lens, what are the types of business models that you would be more interested to see game developers experimenting beyond play to earn?
Personally, no play to earn right now. I think given the whole sentiment, and most VCs have a very big bag of play to earn, to be very honest, I would assume at least. It's about actually the infrastructure for the games and the transposability that you were talking about is where I would personally be interested. But then there's, a caveat with that saying is that you could build that technology, but getting it accepted by the big publishers is actually where the real barrier is right now. So I think that's still hurting a lot of sentiment, but still building that technology to port assets across whatever amount of IP it may be is important, where a lot of people and companies are doing that right now.
Maybe from me, sorry, maybe from Venture's perspective, Q1 and Q2, we were looking seriously at gaming because we launched our gaming guild in Swissborg called XBorg. And through them, we were getting a lot of interesting deals. And maybe I can say, from our point of view, we were always focused on gaming studios because just the model is more sustainable because most games are hit or miss. So I can say that especially, and I find the gaming studio model more interesting because when they have NFTs, then the player has multiple venues to play the games and they're all connected, like the thing that I mentioned in the beginning. I think that we're very far away yet from the whole ecosystem being connected, so you can, get your avatar and then you can play every single game. But then at least game studios maximize what is currently available as technology. And we, as a fund, we used to find that really interesting.
Yeah, I think beyond just the play to earn, there's a lot of new models emerging. Even looking at the older models like free-to-play games, you don't necessarily need an NFT to be the gateway to playing the game. If you limit it strictly to NFT holders or the people renting the NFTs, you shut yourself off from having, potentially many more users, especially if you're, depending on how many NFTs you have as the game, you might not have enough for what you need for the amount of players. We invested in a company, Splinterlands, which I'm sure many of you are familiar with. They have a really interesting ecosystem with a 3-token model So they have a governance token, they have like an in-game utility token, they have more of a loyalty points, like reward-based token. And so in addition to that, they have NFT card packs. So it's like a card battle game. And I think it's important to have these different kinds of economic models so that you're not just flooding the entire market with, unfortunately, like Axie did, right? It's like, okay, yeah, that works if the thing is growing. You can constantly earn the rewards even if you're losing the game. And the players have no risk, right? Of course, you're just going to be farming the token, which, during the bull market, that's great, but you need to have, they call it sinks and faucets, right? So you have to have a token emission model if you want to gain user base, but you also have to suck up those tokens, and that's the faucet, and burn those tokens or have some sort of cyclical model so that it's not just all inflation, because we all know what happens if you just print endless money. Your currency supply goes to
FTX.
Yeah, exactly.
That's interesting because I think like from the gaming, at least like business model innovation perspective, like do we really need that kind of innovation there? Like there's very well tested models that work very well in every kind of category of game, mobile games, console games, etc., where probably you don't need really like significant innovation. There's leverage things that are working well today.
Well, I think the highest utility and the most interesting part of NFTs that there can be a common marketplace for them, right? At least at the moment, I'm not aware of such a common marketplace for in-game assets. So it just connects all the games, and usually players, they would have at least 5 top favorite games. So being able to actually own that asset, and depending on the game, sometimes you own the asset for just limited amount of time or like limited amount of energy that you have. And NFTs just give you the opportunity to actually own what you earned, and we know that for gamers is really important. And also it gives opportunity to actually make some money out of it. So I'm not such a fan of the model play to earn for tokens, but I think the model for NFTs works really well. If you do small investment, if you're a really good player, then you build your character, collect, and then you can sell them in a common marketplace. So now you're not limited but by, let's say, the 10,000 players in this game particularly, but then there are way more buyers in this common marketplace. This is where I'm seeing the value add.
Yeah, it's pretty interesting because I think also like from the crypto gaming perspective, it does have like a geographic flavor as well. Like if we look at certain geographic markets, for example, Korean market, Japanese market, you have some pretty significant game development studios there. And I think it's a little bit more visible what that pathway for growth looks like in specific geographies. I'm wondering from like the investor perspective, what do you think are some of the key drivers for that? Is it maybe the user's perceptions around like, these carbon emissions around NFTs, which we saw in like Europe, probably like consumers and gamers there are maybe more aware about that. Interested to hear your thoughts about that.
I think culture is a big part. Like even here in UAE, gaming is a big thing, right? In South Korea and these nations you're talking about, they have those, what do you call, PC bang cafes, right? People are gaming heavily, so it's just that natural inclination, and why you're seeing those growth numbers specifically. And then in Europe, as you said, it's kind of like the opposite, where you have a stigma attached to NFTs, or similar to how you had to POW as well. So I do think a big part is with culture. And then, speaking about Axie, in these, I don't want to call them third world countries, but people are playing not to actually have fun, but as a job, right? Which we all know how that kind of ended up.
Yeah, I think that's interesting. Axie has been an interesting case study in which we saw like really the play to earn model became like labor in ways, and you even have like labor organizations that formed around that, right? And they just call them gaming guilds, which has been kind of interesting to see the development of that. But do you think like those types of organizations have a role for games? I mean, gaming guilds are not new, right? Like even for non-crypto games, traditional games, there's been a community, like that's the key part of gaming. How do you think that's going to evolve in the crypto space?
Maybe I can give an example, since the question is very relevant to what Swissborg is doing over. I'm working very closely, as I said, with the gaming guild Xborg, and they did something incredible. Like I was not so, so bullish about gaming guilds until I saw it in action. So they're extremely picky about the games that they're providing to their community. And even in this bear market, when the market was dropping, they issued NFTs. And here, actually, I wanted to highlight and underline how NFTs can have certain utility and can be actually valuable. But I also treat this as sort of a membership, but it's like way easier, digitalized. So what they did was issuing NFTs, they got oversold, and the actual utility of the NFT, there are multiple things, like they have a separate group, let's say, for premium games. They have access to deals, which is very unique in the sector, I believe. So they have a list of things, and they have a very, very strong community. So I believe that definitely there is space for gaming guilds, and even I have been starting to see these platforms for gaming guilds emerging. So definitely that sector is growing. I'm quite bullish on it.
Yeah, I echo that sentiment. I think with the guilds, you have a really captive user base, right? Each of these guilds has communities of thousands of members, tens of thousands, some of them I think over 100,000 now. You know, these are gamers that are ready to play. They know how play to earn works, they know how blockchain and digital wallets work. The key part with guilds, though, is trying to maintain those users, because oftentimes the guilds come in for a few weeks when the incentives are quite high for the new games. They play the game for a few weeks, then they immediately sell all the NFTs, and then they cash out all the tokens. They go on to the next game. But the idea is that the guilds do bring in initial user base, which can be, of course, helpful for the sort of funding perspective to get more venture capitalists to invest in your project, you know, if you have high daily active user count. Although people are becoming a lot more sophisticated as they look at, you know, not just 1 month's data, but multiple months, especially now in the bear market. You know, investors are doing much more due diligence because there's not that same FOMO aspect. It's not like, oh, tomorrow and you have to get in today, make a decision within the next 24 hours or you're out. You know, the power's back in the hands of investors, the VCs, and the time as well. So, but I think the guilds are really a key component, just as they were of Web 2. I mean, if you look at World of Warcraft, Battle.net for StarCraft and Warcraft 3, like one of the key components was that you had the guilds and people coming on not just for experience as an individual, but they also come for the social experience. In fact, my cousin who works at a software development company, one of the reasons he was able to get that job is because he was able to talk to his boss about, hey, in World of Warcraft, I'm actually a guild leader, and I have all this experience. People all herd cats a little bit, just like crypto people, you know, trying to get everyone to come online at the same time to go fight a boss. You know, I think the component social and also for, you know, adoption, right? Because the guilds are a teaching platform. They teach people how to use infrastructure in the cryptocurrency space. So I'm bullish on that. And you asked the question earlier too about the different cultures and everything and the different models. I think, you know, the X to earn, let's explore all of those. Learn to earn, play to earn, you know, sweat to earn, for fitness, you know, everything. Yeah, let's try it out. Let's see how it works. Though is, yeah, you can't just, whatever model you're doing, think about the economic implications of it. You can't just mint free money forever. If that's your strategy, that you're just going to mint tokens and people will come and you know, buy them constantly, that's not going to work. You have to burn them as well. And so you have to think, okay, what's the cyclical model such that, you know, you emit them, but then you also collect them back. And what do you do with it once you collect it back? Do you offer it as staking rewards? Do you offer it as affiliate marketing rewards for people to grow your user base? Do you offer it, you know, for in exchange only for NFTs? Like maybe you have a token that can only transform into NFTs. It can't actually be traded on DEXs, or at least, you know, not easily or whatever, right? You can have this like Web 2.5 hybrid kind of model. So I think it's important to explore all of these different aspects of GameFi, but also applying gamification to traditional you know, types of industries as well, because gamers and gaming incentives and mechanics, I mean, everyone likes cheap dopamine. So how do we, you know, use that for good to incentivize behaviors that help people grow? I think that's going to be the key.
This is interesting. I think also another area that's kind of limiting in some ways the growth of gaming adoption is also the user experience. You know, like a lot of other panelists have talked about this as well, but it's also about the issue around, in some games, having to custody, you know, how to set up MetaMask and all of those kind of things, which kind of limits in many ways the total addressable market for players. So I'm curious from that perspective, how interesting is looking at like those type of enabled solutions, also infrastructure on the scalability side, so including layer 2s that are more specific for gaming, beyond just the game studios and let's say the content development side directly?
I think that's extremely important, not just as gaming within crypto, but as an industry as a whole. UX is not great right now in any way, and you pointed out some of those issues right away, right? ZK Sync might be something that'd be applicable to games going down the line, given what they're doing. Speed, and then of course, when you have to use a ledger or MetaMask, whatever it may be, especially now that everyone's moving off-chain onto their own self-custody wallets, the user experience is completely garbage, right? Especially if you're a new user to crypto. Add on top of that, you're using crypto assets within a game as well. It's, I think, as an investment sector, as infra, that will then also be used within these gaming categories is extremely, extremely important just for the industry as a whole, and not just gaming.
I fully agree with this. I think the riskiest part about the NFTs in gaming is the extremely volatile price and everyone having a separate platform, right? So when you have low volume, you have a very small amount of buyers or sellers. Then obviously you get a lot of volatility in the price, and also most of those platforms, they have their own token as well. So you have two levels of price volatility. One is the token when you're entering, then you have the price of the NFT, and once you're exiting again, you have the volatility of the underlying token, which I believe makes gaming so risky. Capital-wise, and such platforms that are helping the interoperability and that are connecting the ecosystem are a very key factor for overall like blockchain in gaming to go to another level and be way more adopted.
Yeah, definitely agree. And I don't think everything has to be on-chain. In fact, with most blockchain games, not everything. And in fact, most things are not on-chain. But when it comes to the NFTs, when it comes to the reward incentives, a lot of those go on-chain, but not all the time either. I mean, you can have assets where it's an in-game asset, not an NFT at the beginning, and then you can mint it as an NFT later. And maybe you have to pay some sort of token like the currency that you create, if you're creating a cryptocurrency for that game, that can be used to actually redeem the NFT. Things like this where, you need to actually build utility into the tokens themselves. You need to have a reason for the NFTs to appreciate in value, right? So if you're minting just hundreds or thousands of NFTs willy-nilly, like it's not going to be good for the quote-unquote investors into those NFTs, right? But, it might be good for the company generating maximum profit. So sometimes it's about balancing those incentives. I mean, especially if you look at someone like Riot Games with League of Legends, like they don't have an incentive probably to create NFTs for their characters, because why have a resale market when everyone's just able to buy them primarily infinitely and have no concern about how many are minted? Like, who cares if everyone has the skin, right? I mean, obviously they make some rarer ones than not, but so yeah, I think it's important to look at the technical architecture of the various blockchain games and like see, does this actually have to be on chain? And if so, why? Because you have trade-offs. You have cost trade-offs, time, depending on which blockchain you're building on. A lot of them, it's not fast enough. And you don't want to have to click confirm every time you have an in-game activity. That would be super annoying. There's the gas component, and especially if you're the game developer, it can be super costly to the tune of millions of dollars per month in gas fees if you try to run too much of your game on-chain. So it's like use blockchain when you need to, but be smart about it and don't necessarily put everything that can be on it. Because I mean, look what happened to Axie as well. I mean, you had that hack by North Korea, right? What, $600 million worth of value gone, right? So that's there's also a huge security risk depending on how your chain is governed, and we have to be cautious about that.
Yeah, I think it's interesting. Like we see continued progress and development around, for example, wallets that allow users to do the Web2 style login with Google, login with Facebook, take your pick, but has a Web3 wallet behind, and users don't need to custody, seed phrase, private key. Right, so there's like, even on the scalability side, like improvements happening there as well. But Ultimately, like another big challenge is the distribution channels, especially for console and mobile application games. For browser-based, it's not so bad, but for console and mobile apps, you still have these major gatekeepers on the distribution channel. And that also, it's like uncertain of how that's going to play out, when that's going to change, you know, like is iOS going to start supporting crypto apps or not, you know, like, and then change the rules in later stages, like trying to move away from closed economy to open economy, you still have these major gatekeepers there. Like, how much of a risk is that, and how do you develop like risk mitigation on this?
Well, I think previous 2 weeks ago, a big proponent or something that would be pushing that forward was the Solana phone. Like, that would really help gaming, but God knows what's happening with that right now, I guess. Unfortunately. How do we risk mitigate against it? It's like David and Goliath at the end of the day. You got to keep building around the side, finding whatever loopholes you can exploit to get your distribution out there, right? Like back when iPhone 5 was out or whatever the earlier models was, you had Cydia, that hacked version of iPhone, right? And then you can have all these bootleg apps. It's the same case. That's where gaming distribution will happen on mobile. And we know mobile is a very large percentage of gamers right now.
Yeah, it's been interesting to see Apple and the moves that they've been taking to try to dissuade people from using outside of in-app marketplace. Because, of course, Apple, if you buy it through the website of some company, you know, the in-game currency or the NFT of the character or whatever, Apple's not getting their cut. So they're trying everything they can to prevent people from, you know, doing that. And I forget the legal status because they lost some case against one company that it wasn't even to do with crypto, but that had a separate marketplace for their characters and in-game assets versus the App Store. And so they're constantly trying to limit the ability to buy. So you can't, I think one thing they did more recently was like you can't link to the store through the app. So if you can buy items, you know, on your website, you can't link to that website through the app. However, you can, you know, as long as you don't link to it, you can buy through the website. You can also buy, you know, through the application. Apple takes their cut in the app and not on the website. Actually, Audible kind of works that way too. Nothing to do with crypto, but they have, you know, the Audible credits, which you can buy through the app. Apple gets their cut. But if you want to buy books using cash, you have to go through the Audible website through Amazon. So, you know, these kind of things, it's a challenge. I mean, and eventually we need decentralized app stores that are, you know, blockchain native and that are friendly to crypto companies rather than trying to combat them.
Yeah, I definitely agree with that. And we do see some projects that are going in that direction now. That are trying to build the distribution channels themselves, that are trying to build those decentralized app stores as well. But ultimately, like today, it's still one of the big friction points, one of the big risks, definitely from investment perspective as well. See, we're coming up to time, but just wanted to close the session on giving us your perspective on which are the kind of like gaming categories that you're really most bullish on, either like sports gaming, first-person shooters, like what's the kind of perspectives that you can share here with the audience in terms of like the most interesting games that you're seeing developed?
I have been seeing a lot of RPG, and as I said, like in terms of investment, we're always looking for gaming studios because they offer a variety. You never know which game exactly will work and exactly with the type of graphics that they have and the existing user base, like what they would like. So I would always prefer to see different type of games. And also, I think he said something very nice, and it's nice as a closing remark also, that use blockchain, but don't overuse it where it's not needed. So I think used in the right places is best. And also, I'm very interested seeing Web2 games that have already existing community and fans transitioning to Web3. We didn't have time to talk about it, but I had seen the challenges firsthand. It's not as easy, actually, as it might seem, but there is so much use case there for them because they already have the existing players who have the assets, and there are a lot of new community members that would love to acquire those assets. So see, like NFTs would have great use case there.
From a numbers perspective, MOBA, definitely, just because of the stickiness of users. Personally, FPS, but yeah.
Yeah, I think very bullish on the traditional game companies getting into crypto, you know, Ubisoft experimenting with NFTs, et cetera. From a VC perspective, though, not as interesting for the seed rounds and such, but yeah, I think that'll help massively in terms of user adoption of crypto and NFTs. And then beyond that, I think people that are innovating new models, go-to-market strategies that haven't been tried before, innovating around not play to earn, but there's play and earn, or there's all these iterations of this. So I like to see when people have a really unique go-to-market strategy, because no longer is it just like, oh, I have a vision for a game and we're going to build it, and maybe we're just blockchain people that don't know anything about building games. Now it's like, okay, we're a game studio, we know blockchain, we know gaming, we've built this, and here's how we're going to do something that no one's ever seen before. And there's actually a few companies here that's the case for, so congrats on Agora for organizing this and bringing together a lot of really interesting projects in the play-to-earn / GameFi space. Really excited about that, yeah.
Thank you guys again. Thanks a lot. Really appreciate you coming and sharing your insights here.
Thank you so much, and thanks again to Agora for organizing that.
Thank you.
They switched to
Big round of applause, please, for our panel. Very interesting. Maybe we can do a group photo, ladies and gentlemen. Group photo. All right. Go. All right, we're coming up on our last panel of the day, and then we're going to be heading into the business meetings. So coming up, we have Web3 Unlocked. Our moderator is Nicola Stojanow, general partner of Meta Change Capital. Nicola, are you here? Yeah, Miss. And you can engage in a continuous round of applause as they come onto the stage, everyone. So Andrew Rollstone, Chief Marketing and Business Development Officer, Zoko. Tatiana Metodieva, CFA, Head of Corporate Finance and Investments, Nero. Kareem Bana, Web3 Program Manager, Brink Mina. And Lorenz Aparius, Founding Partner, Blockwall. So big round of applause, please. I want to hear about Web3 Unlocked. Rocket. Or we have a working mic. Yes, we do.
Test.
All yours.
Gordon, thank you very much for the introduction. First of all, thanks to everybody who has actually stayed here until this moment to listen to our panel. And thank you very much to the panelists that have joined me here. Being able to listen to the previous panel who touched points on gaming, NFTs, DAOs, guilds, security, and other topics that are quite interesting, I think I'm going to change up our panel a little bit, so stay with me. The topic that we have today is Web3 Unlocked, but I think right now when we look at the entire landscape, I would go with Web3 Locked with a question mark behind that. And just for everybody to understand where I want to go with this, I want to see where we are at right now, like how things are going. We have a beautiful panel. We have a mix between venture capital and hedge funds, an accelerator that is working globally, Zokyo, who is one of the security leading audits in the world, actually, to be honest with you, and Nexo and Nexo Ventures representatives here. So I think we can get some really cool insights, what is happening right now, and most importantly, what are the next steps that we're going to be seeing in the entire sector, because clearly there are massive issues that are happening, and this is not a healthy ecosystem that we're in. When I go back in time, I look at 2017 when ICOs were a thing. People got incredibly lucky. Somehow they were able to raise funding, but somehow, in my opinion, also accountability was lacking. Leadership was lacking, and skill sets were lacking that are now coming to light and are creating incredible problems. And I think that one of the biggest things that we're seeing right now and that everybody's talking about is the recent epic failure of FTX. And for me, one of the very interesting points that I was able to read was that Nexo and Tatiana, please, I hope you can actually share some information about this firsthand. Nexo was one of the few companies in the world that said that they were not able, that FTX was not able to pass the actual due diligence when it comes to risk management, when it comes to compliance. So, and when we look at larger companies like BlackRock, Sequoia, A16Z, you know, all the big names that everybody's dreaming about, they went all into it, and one way or another they wrote it off. But how did you guys decide, or how did you guys got good enough to be able to say, we're going to pass on this, this is not for us?
Well, certainly, we at Nexo being the largest retail-oriented lender in the digital asset space and one of the largest institutions with more than 6 million customers globally, we have been a counterparty to FTX like all the global players, but essentially we have never considered investing in FTX because it was beyond the standards of risk management practices and due diligence that we would be comfortable with. As you may have seen, we officially announced that we did our due diligence. We started doing our due diligence even during the summer, and we managed to withdraw right on time all the assets that we kept on FTX platform a few days before actually the collapse unfolded. We had, of course, being a lender in the digital asset space, small loan with Alameda, as all of the CeFi companies, but again, it was very minor, and we managed to liquidate the collateral right on time. Again, our risk management practices, our due diligence that is done by the TradFi principle allow us to move very quickly and confidently in light of the recent events.
Thank you very much, Tatiana. Respect for that, by the way. Lawrence, you guys with Blockwall, you're on the other side. I mean, you guys running a venture capital fund, you're running a hedge fund. From what I understood, that you guys did have some exposure into it, but because, again, of, let's say, pretty good risk management, you kind of averted that sinking ship. What was your experience with that?
Well, my experience is twofold. On the one side, I have investors that I need to account for, so they invest in us, whether it's a family office or a pension fund, because they see that we have all the tools in place to do what we do, which is taking risk, but also to manage risk. When it comes to managing risk, on the case of FTX, we treated it like any other venue, whether it's a smart contract, whether it's another exchange. We limited the exposure we had there. And to be honest, we also gave some trust in the reputation it had built, given the investors you mentioned earlier. But that doesn't matter to us because it is and remains a counterparty risk. And since we come from a traditional financial system, we treat it equally. So what I'm saying with that is this wasn't the first. It won't be the last default in a growing, innovative space. But what remains is, as long as we're not at a stage where it's fully auditable, where it's fully regulated, from what extent whatsoever, there is always a counterparty risk. So, and what I've seen over the past 2 years is that it has been a FOMO, hype-driven investment sphere where money has been thrown around at projects without any due diligence whatsoever, purely building on monetary expansion. And to be honest, it's a very good cleansing that's happening at the moment, which happened in this industry before. So with every downfall, there's also opportunity, and there's, in our opinion, a very good opportunity that alternative solutions that are transparent, such as on-chain diagnostics and on-chain tools, are becoming more and more important, but always keep in mind that there needs to be a connection to the traditional financial regulatory world.
I love the optimism about this, but I'm just going to continue playing the devil's advocate here, because I've seen the cyclical behavior for multiple times now, and you know, like this hype cycle that you mentioned, and you know, this ease of access to capital without having a properly proven concept. I'm not talking about a product, I'm talking about a concept, so even one stage below that, in my opinion, is an incredibly big risk factor for the entire space, because when we look at classical venture capitalism, you go through rounds. You have an idea, you get some basic funding for it, then you go through the seed stage, you get some more, you prove your hypothesis, you go into the process of being able to test the different channels, get your first customers, and then if successful, you go into the next rounds. With crypto or blockchain in general, you skip all that, you move forward, you raise a large amount of capital from day one, and then you're left with delivering on the project. But here's the kicker. The moment you're talking is actually tradable, you run into the issue that, in in my opinion, it becomes your biggest task to manage the expectations of the token holders rather than focus on your product. Now, Karim, you guys are running pretty big acceleration program, actually. How do you cope with that? Because clearly this is not going well.
I agree, and I think one of the main advantages of running a venture accelerator is that we get to work with the founders from the pre-seed and seed stage, and we go through a whole curriculum with them and really manage a relationship with them. Even after the program, we have a portfolio team that is connected with them, and we manage a quarterly review with their financials. So we get to know them really early on, and we get to see the progress as they come in. Whereas if you have investments that come in at a later stage, they have to do their due diligence and go backtrack it. But with us, we're actually there holding their hand throughout the whole process. So I think that in this kind of market is really important, and it's really been exciting working with those early stage startups.
Questionable to me, if I have to be honest with you. But Andrew, one thing that I wanted to ask you is, I mean, Zokyo, again, I've known Ardesh for years, and I've seen how it went from Hosho to Zokyo, how auditing smart contracts and security became such an important but still overseen aspect in blockchain or Web3 in general. When you guys, or like when this entire process happened, especially compared to the last 6 months, how has the communication with the startups been? And most importantly, because you guys also invest, because you've opened up a venture arm on this, how has your strategy changed in that aspect?
So, I mean, our positioning is one where we align with the VCs in the sense we actually encourage the VCs to lean on us to do technical due diligence on the projects that are on their table. So, of course, like with VCs, they have in-house capability, but it's always good to have. Like,
so you want to enable the VCs to say, hey, this actually makes sense.
Yeah, well, they would say, hey, can you have a look at the code? You know, how strong is this code? So we're very much on the, our focus is very much on the code itself, specific to smart contracts. So we can actually relay to the client, or sorry, the VC in this instance, who are effectively our friends, because they entrust us to, use our expertise in giving comment on the quality of the code, and we will give them our frank feedback. In turn, it may lead to them, the project themselves actually securing our services. Also, it presents an investment opportunity for us as well. So our strategy is one where aligning alongside VCs is one where we secure opportunity and we complement the whole ecosystem and effectively complement and strengthen their investment as well, because essentially we're on the preventative side. Our very existence is to work with projects to make sure, or certainly help prevent hacks from occurring. We're very much on the front line at the very first stage of that. Of course, hacks are always going to occur. There's no cure for hacks not occurring. But the more focus on auditing, perhaps multiple audits by multiple auditors, there's no limit on how many audits you can actually do.
I'll give you the perfect example on this. One of my favorite topics in the world are actual bridges.
Yeah.
I mean, I'm sure the majority of you people have heard what a bridge is, but for me, a bridge is one of the biggest issues when it comes to security.
Yeah.
Because creating a bridge between two infrastructures that is incredibly untested, because not enough people know how to test the technology yet, it is a huge issue. If you test a product, that's one thing, but what happens with those interoperability aspects that do not depend on you? You can't test everything. So the risk in itself stays the same.
It's a challenge. I mean, we're looking at, I think there's been over $2 billion of bridge hacks alone this year via 16 individual bridges. It's a significant problem. It's a huge vulnerability point.
Can you repeat the number? I didn't hear.
Over $2 billion of hacks this year.
Yes.
And 16 bridge hacks.
That is also pretty interesting, because when we look back at Terra, when we look back at bridge hacks, when we look back at the entire DeFi movement, which was supposed to be the salvation of blockchain, but actually turned out to be more of an issue than anything else, because at the end of the day, treasuries were more used to subsidize things rather than anything else. Very, very, very important things. How and what have you guys been able to work with them together in order to make it better? Because 60 billion, roughly the estimate, that has been lost versus, I think, what was FTX 9? Right, so the retail sector got hit way worse than the actual professional investors.
I think, like I said, there isn't like an actual solution. I think, a solution that fixes all of the problems. But in terms of recommendations, I think the recommendation is to have, projects firstly have to budget for security. Firstly, they got to hire in-house security expertise, have a high caliber, top-notch head of security in the company, and that individual builds the in-house security team and has the expertise to work with third parties such as ourselves, because a CTO isn't a security expert. A head of security is a security expert, and that's really important.
Go ahead.
And lastly, when it does get to the stage of actually doing an audit, it's collaboration. It's direct collaboration with the developers of the project and direct collaboration with the auditors of the project. So they're working as one. That's really important.
I agree with the security aspect. Where I want to stretch the argument about bridges is it was a luxury phenomenon over the past years because they're completely unnecessary. The moment you start using a bridge, it's like using a patch for something where in a bit of time there's going to be a proper solution, but we're going to pour a lot of money in it, knowing that it's going to be a horrible solution. And what does it actually tell us? And I'm just looking from the view of an investor. It tells us, again, what I mentioned earlier, there was too much money willing to be spent on inferior solutions. And on the other side, there was not enough stamina in the market to wait it out. Because what am I doing as an investor? I look at binary outcomes, what makes sense and what has a chance to succeed, which is why I understand why Bridges got money. And the other side, like, breathe out and be patient. And thereby you'll see where there's quick money chasing inferior solutions, and on the other side where there's good money being used by good teams with a good approach to actually build decent solutions down the road. And as a last point, the fact, again, about bridges, why they existed in the first place is because DeFi as a topic was not as sticky enough yet so that people would remain within one ecosystem. They flip back and forth, NFT here and there, which is just also another phenomenon of expansionary monetary policies at the end of the day.
What I'm hearing out here is two very important things. Stepping stones, you call it inferior technology, I'll go with stepping stones. And then proper, not only budgeting, but also strategizing when it comes to how to build a product. And Tatiana, how do you guys actually look at those things when it comes to your investments? Because you've done what? How many investments has Nexo Venture done in a very short period of time?
Well, essentially, Nexo Ventures was established as an in-house investment fund of Nexo, 150 million dedicated to Web3 development and building, which we officially launched in the beginning of March this year. But by that time, we had already completed about 35 to 40 investments in this Web3 ecosystem. So far, we have invested in over 60 projects, and we have been supporting them from the perspective of a strategic investor. And this is what clearly differentiates Nexo Ventures from most of the VCs in this space, is that we position ourselves as true partners of financial VCs. Most of them, are predominantly focused on extracting the alpha, the return on investment, generating the yield, and we want to bring the strategic value that will build bridges in this community. Thus, we want to show these early stage projects, these entrepreneurs, that there is additional value at Nexo being a partner of theirs. And we could integrate their projects, we could work together to educate them, to facilitate their go-to-market strategy with our marketing, with our fintech expertise, and also with our huge community. You would understand me very well when you market your project in front of an audience of over 6 million people. For early stage projects, sometimes this is even very valuable as a support.
Very quick question to add on to this. Are you investing only into projects that are planning to create a token, or also investing into projects that don't need one?
Our general approach to investments is agnostic, so we invest in both equity and in tokens. Our general preference is for equity investments, and this is how we could bring more value to the projects themselves.
Cool.
So just a little background on Brink. We're a venture accelerator based out of Hong Kong. Been around since 2014, have 250 plus companies in our portfolio. Last year, Animoca Brands invested in us and then earmarked a $100 million fund, which we're now deploying for the past year. $250,000 tickets, and to the question that is asked, Animoca Brands does get equity out of that, so it's an equity plus a token grant, and that's how it runs. So for us, it's any project in Web3. The tokens are, some projects that we're looking at don't have tokens, and actually some of the recommendations coming from the experts are saying maybe not now, and so we're looking at different approaches for that. But that's how we're running it for the past year.
You guys think this is viable, like as a model with the tokens before? And I'm going back to this because I do have an issue with this, seeing what is happening right now. I'll go out with the hypothesis, I think projects should not be able to generate a token before they don't have revenues. Prove me wrong.
No, I agree, and building that community is so important before you...
This goes out literally to everyone. Like for me, this is something that I'm directly saying here on stage. I think you need revenues, you need a proper product, and you need proper structuring. Vesting schedules for teams should be multiple years rather than 3 months. Same like early stage investors, whatever, influencers kind of stuff. I think this should be way more strict. What do you guys think?
Well, to put one thing first, I think tokens, if structured correctly, can have a very viable future. What have we learned so far? In 2017, there were a lot of ICOs and retail got ripped. In 2021, we had IDOs and we had VCs that bought very cheaply and sold very highly to retail, so retail again got ripped off. So where are we headed? These are stepping stones. So where are we headed? A token economy can have a sense if it is structured correctly, which means at the end of the day, it acts and feels and is a security. So as a token holder, you not only have right to vote on anything, but also participate in the platform revenues. And there's an equal amount of business models where there's no token that has any viability, so an equity structure is much better suited. So it really depends on what the business model is and how and with whom money will be generated on that platform. And that's a very clear distinction that one needs to make. We've dedicated funds for each direction because it is a very different beast either way, and that's at least the way we look at it.
Guys, please, I want to hear your opinion, and I think everybody does.
I mean, with us, we're also seeing now SAFT. So you're seeing simple agreements for future token grants. And I think there's a lot of recommendations not, to not issue the tokens right now is to kind of build that community, build that revenue like you're saying. And then once you have that traction and growth, then that's probably the better time to do it. So that's the kind of recommendations we're doing within our accelerator.
What I have been noticing quite openly over the last few months after May is that most of the companies have restructured their offerings, being more inclined to provide a safe note to their investors with a combination of a token warrant, and this is the preferred structure that most of the VCs currently go for in light of the recent events.
I'm not an expert in this subject, so I'll answer it from my own experience and from what I see as a retail. So there have been a lot of mistakes that I've personally seen. So I agree with your point where there shouldn't be a rush to list tokens. There's often, from the founder's point of view, an urgency to list the tokens, perhaps for internal liquidity reasons. I'm not entirely sure. But for me, I've seen platforms that haven't gone mainnet. The tokens have listed at least 6 months before they've actually gone mainnet, meaning there's no utility for the token. So what's going to happen to the token, irrespective of market conditions, is going to have a downward trend. So you see a lot of tokens now which have lost 90% of their value in a lot of cases because there's no utility for them. So to answer your point, I actually agree with your view here. There needs to be some change. Patience needs to be in existence. And perhaps even at a retail level as well. Investors or token purchasers need to have the similar mindset to what VCs have, and perhaps have the same offering as what VCs have, because retail obviously get in at a higher price typically.
So Conceptually, I agree. Reality has proven for centuries that greed is a very powerful animal. So that's why regulation is in place to protect retail. So at least professionals like VCs or hedge funds should know better, but reality also shows there's a lot of greed involved. So at the end of the day, it really comes down to the individual actors to provide for a good product offering, management of funds or deployment of funds.
You were speaking about patience. I think I can start calling it negligence at some point of time in this case. You know, like there's one thing to be patient back in 2017, there's one thing to be patient in 2018, 19, and 20, and so on and so on. Now we have to be patient again because somehow, I'm not talking about regulation right now. Being very careful here. I'm talking about best practices which are transferred from the classical company building space into the Web3 space. And I genuinely believe that patience has run out and just some proper change needs to happen. And like people like us that are sitting at this on the stage and the people that are in the room here, we need to be able to move this forward and be like, we can't do this anymore. There needs to be a stop. You need to say, hey, you need to do something, you need to produce something, and then you can get rewarded for this. But having access to 100% of your treasury at such an early stage without having proven anything, to me is dangerous. I've seen it too, I've experienced it myself. I think we raised like 30 million back in the days, and that exponentially grew at the first bull run in 2017. But it's too much access without having like the setup for it. How, Tatiana, like, how can you counteract to this? Like, how can you be like, hey, you know what, Joe, I know what I'm doing. It's not my first investment. You should listen to me rather than, you know, just going absolutely wild because somebody's going to give you $500,000.
Certainly, if I have one advice to the fellow professionals here is to focus on fundamentals and do your own research, focus on due diligence, but not this brief and concise due diligence that we used to see over the past bull run where greed and hype were overwhelming the market. We should focus on fundamentals and sound business models. For example, if I may just make parallel with Nexo here, our company is still 100% owned from the founders. So we have never played the VC game and we haven't attracted external capital so far. So bootstrapping successfully through reinvestment of earning and prudent risk management practices. So we haven't also engaged into the riskier practices of under-collateralized and non-collateralized lending, and we haven't made any exceptions, neither with FTX nor with Three Arrows Capital, both of which came to us and wanted us to forego our risk management practices and lend them on an uncollateralized basis. We said no. And it was applicable both to our retail customers and to the large institutions that we cooperate with on a daily basis. And you just mentioned the topic about regulations. We know that crypto regulations are non-existent yet, but we know that there should be and will be some regulations that will bring more clarity and attract institutional players to this space. So we have been pursuing very heavily licenses and registration in those jurisdictions where we operate in and for those activities for which these licenses should be in place.
Look, I get you, Lawrence, but at the end of the day, you got to make money somehow, right? So, you know, like, it's great what I'm saying. It sounds absolutely amazing, but how do you perceive that right now? Like, do you agree? Do you think I'm full of shit? Or
So my mandate as a fund manager is to provide a return to my investors. And how do I do that? I pack away any greed. I try to remain as logic as possible. And I mean, what's happening right now is it's a self-regulating industry. And what do I mean by that? It means that those funds that deploy capital into this innovation that are surviving are the ones that remain disciplined in what they invest because they know why. They don't get tricked by good entrepreneurs. And it also works out because at the end of the day, what we need to achieve is where innovation can progress no matter where the market is at the moment. And this is really how we approach it, which we enforce, for example, by telling founders like, you can come back when you meet this valuation or vesting or lockup criteria, because any other thing will look like a dumping scheme, will smell like a dumping scheme, and will probably be a dumping scheme. And then no one wins, and it's just going to burn capital. So it's a few rules, discipline, and a long-term vision that counts.
A few rules, discipline, and best practices. I'm going to throw that word in again. You guys need to find startups, like you need to be able to fill a quota, you need to be able to do a certain amount of investments, and so, in your case with the acceleration program and Zokyo at the end with your clients together, it does make also sense. How do you maintain that level of excellence and make sure that you don't slip through the cracks and you're like, but this does sound so good at the end of the day. Why don't I close one eye?
So for us, we know that not all startups will survive, and so we do everything to de-risk and give them all the tools that they need to succeed. And what that looks like is basically we put them in front of real experts in the fields. We give them the advice that they need. We also, as they come into the accelerator program, we actually invest a lot into the teams, into the founders. So we look at the founders, and every quarter we get reports, audits, and statements of what they're doing. And then we try to stay with them throughout the whole journey, but work with them to kind of de-risk that, and then try to get, after the program, is to get them investment for at least 24-month runway. So that's usually our mandate, is just to make them more investable at the end.
Andrew?
For us, when we make an investment, we made about 10 investments last year. Generally speaking, pre-seed and seed round. We're strategic investors, so we encourage the project to lean on us for the security. Obviously, our brand has recognition in the market as well as a top-tier security company. And obviously, we're very well connected with VCs as well. So we really add value by way of making introductions to our VC partners as well to help them generate their capital and just really leverage off our network to hopefully lead them towards success.
I think I could easily dive into the team topic and the leveraging topic. We're not a couple of hours here, but we're coming to an end. And if I can summarize this, I think we can agree that at the end of the day, it does depend on us, and we kind of have to be the examples that we want to see in the market. And sometimes this is hard, and most of the times it's complicated and not easy, but it starts with here, it starts with this panel. It starts with everybody that is here, and probably outside drinking coffee. So thank you very much, guys, for being my panelists today, and thank you, everybody, for listening. I hope you enjoyed it, and I think that's it from us.
Thank you.
Thank you very much.
And of course, let's do a group photo. All right, now let's give a big round of applause for you, the audience, because you have completed the first day of the Agora 10th annual Agora Blockchain Conference, or 10th semi-annual, not quite sure. But a big round of applause to you. Let's give a big round of applause to coffee and carbohydrates waiting for you outside. Okay, fine. And see you tomorrow. And don't forget, there's the business meetings. Talk to you soon. Yes. Good? Cool. I'm sorry, and a big round of applause to Hadi and Rim hiding somewhere. Okay, everyone up.